KPMG's ITES tax practice in India. He has over 17 years of professional experience and has advised several foreign and Indian multinationals in the IT, BPO, media and entertainment and telecom sectors on corporate tax, entry and exit strategy, inbound and outbound investment structuring, expatriate tax and dispute resolution matters. On the regulatory front, he has advised the Indian and foreign companies in areas related to the exchange control, foreign direct investment policy, media and telecom regulatory, STPI and SEZ regulations. So Mr. Agarwal is a regular speaker at various industry and tax conferences and has contributed several articles of papers in professional journals of newspapers. May I request all participants to make a note that the entire proceedings of this webinar would be a one-way communication from CII Gurgaon. The live interactive session would begin after the presentation by Mr. Naveen Agarwal. Participants are required to type in their questions in the question box, which would be opened during the Q&A session, and Mr. Agarwal would take them live one by one and would answer all the questions raised. May I, on behalf of all the participants, would extend a formal welcome to Mr. Naveen Agarwal and invite him to take over the session. Over to Mr. Naveen Agarwal, please.
Thank you, Mr. Rao, and good afternoon to all of you. Wishing you all a very warm welcome. My name is Naveen Agarwal. I'm a tax partner with KPMG. As Mr. Rao gave you a brief introduction, this session is on two significant amendments in the Finance Act 2012 with respect to general anti-avoidance rules and the expanded definition of royalty. Now, before I get into these specific provisions which have been introduced, let me take you back in time to 1991 when the then Finance Minister Dr. Manmohan Singh had introduced the budget at that time. Clearly at that time also the economy was going through a severe crisis. We had a huge political turmoil. There was rising oil prices, fiscal extravagance, and the entire foreign exchange situation was also looking quite bleak. At that time, the Finance Minister had followed a theme which was basically to say that no power on earth can stop an idea whose time has come. And we now move ahead in time 20 years later, and we come into 2012, and the current Finance Minister Pranab Mukherjee was also confronted with similar challenges on the economic front. And clearly what the world is seeing today is a global economic slowdown of mammoth proportions. And amidst all this slowdown, countries all over the world are trying to implement different kinds of policies. They're making substantive amendments even on tax policies. And in that sense, India has been no different. So to put things in perspective, the environment continues to be challenging. India has been resilient in a way to withstand a lot of the economic situation around the world, and has been able to fine-tune its monetary policy to deal with these challenges. But in this year's budget, there were certainly certain expectations that the industry had. As we all know that 2014 is an election year, and this probably was one single budget closer to that time where one was expecting the government to do things which could provide the necessary impetus and spurt to the economy. What the Finance Minister seems to have done is really looking at the entire fiscal situation, has introduced certain revenue raising measures, and the message or the mantra at this while doing this has been, I must be cruel in order to be kind. So let's look at with that sort of a context, let's look at what these provisions are and how these impact taxpayers and the business community at large. So let's move on to the next slide. The next slide is really setting out the agenda. We're going to be talking about two significant provisions. One is with respect to general anti-avoidance rules, and we'll set out the context of and the landscape of these provisions. As we all know, these are going to be deferred, and the introduction of GAAR is likely to be deferred by 1 year. But certainly it has a lot of significance in the run-up to the introduction of GAAR that we need to keep in mind. And the second aspect, or the second part of the agenda, is the expanded definition of royalty. This again is fairly significant because it has a retrospective applicability. There are various elements to the royalty definition that has been amended, and we will look at what those amendments are and how those impact different streams of business. So coming to GAAR, what we intend to do in the first section on GAAR is to, as I mentioned, briefly introduce GAAR, how the GAAR legislation has evolved in the run-up to the Finance Act 2012. What are the kind of issues that are coming up in the manner in which the GAAR has currently been legislated? What are some of the recent developments that have happened? And as we all know that there was a lot of representation that was made once the Finance Bill was introduced, and there were certain changes that were brought in before the Finance Act was passed. And finally, what is it that you as companies and businesses can potentially do? Obviously, we do not have answers to each and every situation because the GAAR rules are yet to be notified. But there's still some level of preparedness and work that companies can do at this point of time. And therefore, the last aspect of this session will really be to deal with some of those issues. So starting with introducing GAAR. So what is the the concept where GAAR comes from? It's clearly it starts with the whole debate, and before GAAR came in, we always had this whole debate around tax avoidance and tax evasion. Now, as we all know, tax evasion is clearly illegal and something which is not acceptable, but tax avoidance is something which is permissible within the framework of law, but is something which is probably fiscally undesirable. And the form over substance has typically prevailed over various decisions that have come over time, but there was really no formal recognition of the substance over form doctrine. And in that sense, the GAAR legislation seeks to do that. It codifies a substance over form doctrine. The starting point for invoking GAAR is really for an arrangement to be established and as an impermissible avoidance arrangement. And for an impermissible avoidance arrangement, there are two conditions or two tests which need to be fulfilled. One is the main purpose test, and the second is what we call as a specified conditions test. Now, if both these tests have to be cumulatively fulfilled, and if they are cumulatively fulfilled, then a transaction can be regarded as an impermissible avoidance arrangement, and then the consequences which are listed on the slide will follow. So let me try and explain what these two conditions are. So the main purpose is essentially to say that there does not necessarily need to be an accrual of a tax benefit by virtue of entering into a transaction or an arrangement. If the main purpose or one of the main purposes of the transaction or an arrangement is to obtain a tax benefit, then it fulfills this test. Now, what is interesting to note is that this is a little bit of a departure from what was contemplated when the Direct Tax Code Bill was introduced, the original form in 2009, and then when the bill was introduced in 2010. In both versions, there was no mention of the term one of the main purposes. This is also not in line with where India has borrowed its draft legislation from, which is from the South African GAAR, where clearly there is what they provide for is the sole purpose or the main purpose test. So one of the main purposes will lead to some level of ambiguity in terms of what kind of transactions could be covered there. The second condition, which is a specified conditions, there are 4 sets of conditions that, and if any of those 4 conditions are met, then the specified conditions test will be fulfilled. The first of these is that the transaction is not at arm's length. And again, one would need to determine whether the tax authorities will actually look at the arm's length test, which is provided under transfer pricing guidelines, to determine whether the transaction is or is not at arm's length. The second condition is with respect to misuse or abuse of the provisions of the tax code, and there has been no definition as to what is to be construed as misuse or abuse. So one would hope that once the rules and guidelines are introduced, there will be some clarity on this aspect. The third part is with respect to the transaction lacking commercial substance. Now, I'll come on this in a little bit, but the last condition is that it should not be for not for bona fide business purposes, and which again has not been defined. Now, stepping back to lacks commercial substance, there is no definition to the term commercial substance. What has really been provided in the law at this point is an inclusive definition to a deeming fiction of commercial substance. So there are certain situations which have been listed where a transaction will be deemed to lack commercial substance. So some example of that could be where the overall effect of the arrangement is different from its individual parts. It could be a situation of a round trip financing where there is really a circular movement of funds outside and back into India. It could be a transaction which has an element of offsetting each other. So offsetting transactions could be covered through this. There could also be a situation where the location of the place or location of the asset or the transaction or the place of residence is motivated by virtue of tax benefits rather than a substantial commercial purpose test. And again, when I talk about all of these, clearly there is lack of sufficient clarity as to what is construed as substantial commercial purpose. So embedded within the definition of deeming fiction, there are certain terms which do not have sufficient clarity. For instance, what is construed as substantial commercial purpose. But in sum and substance, if you are fulfilling both these conditions cumulatively, the main purpose test and the specified conditions test, then the transaction would qualify as an impermissible avoidance arrangement. And like I mentioned, the consequences there could be quite significant, ranging from a transaction being completely recharacterized, and we talk about some illustrative situation where a transaction could be recharacterized. There could become the corporate structure could be disregarded, and again we will talk about an example as to how this could happen. The income and expenses could be reallocated, the equity debt could be recharacterized. So there are far-reaching consequences if a transaction is classified as an impermissible avoidance arrangement. But clearly this is not the final form in which GAAR will come into force. One still needs to wait for the administrative rules and guidelines to come in, and at that stage we will need to look at the impact of these provisions. So let me start with taking some examples just for you to understand and appreciate what the impact of these provisions will be. So let's take an example of a typical investment in inbound investment structure. As we all know, clearly 40 to 45% of the investment into the country comes through Mauritius. It's a favorable investment holding jurisdiction, and a lot of FIs and private equity investors are invest through this jurisdiction, and India does have a favorable tax treaty with respect to exemption on capital gains at the time of exit. Now let's look at three possible situations that could be there, and as is appearing on this slide. On the extreme left of the slide, you will notice a situation where the investment into India through this Mauritius company has been done before the GAAR was introduced, and the exit also happens in a pre-GAAR scenario. The second situation is where the investment happens in a pre-GAAR situation, but the exit happens once the GAAR rules are actually in force. And the third situation on the extreme right is where the investment and the entry and the exit both happen after the GAAR rules are in place. Now, the question would be that would GAAR have its impact on all these structures, on all these arrangements, or will it only be on futuristic transactions? Now, clearly, if you look at the extreme right, this kind of a transaction will certainly come under scrutiny in terms of establishing the commercial purpose and the substantial commercial substance and the substantial commercial purpose test. And therefore it will be under scrutiny under GAAR. If you look at the center structure, one would like to believe that such transactions should not be covered, but the fact is that the taxing event or the trigger for taxability is at the time of exit and not at the time of investment, and that exit will happen in a post-GAAR world or in a situation where GAAR has been introduced, and therefore such transactions could also be potentially under attack under GAAR. And finally, the third structure, which is on the extreme left, one would like to believe that these kind of structures should not be impacted by the GAAR provisions because these were already in place and the exit happened before GAAR was introduced, and therefore whatever tests were established by judiciary should hold good. But in the absence of any clear guidance or administrative guidance in terms of grandfathering of existing structures or structures which have already been entered into, one will not be able to provide a clear view on this. And therefore there is a possibility of this of such structures being under scrutiny as well. So this is a typical situation of an inbound investment structure where there could be potential impact under GAAR. Let's look at another situation, and another situation which is very common in case of an investment into India. Companies typically, have different modes of making investment, financing their investment into India. Normally, you would invest either through an equity, or you could use, normal debt, which is in the form of borrowing, but that has its own restriction in terms of how, where you can use the ECB. Or you could also go for a quasi-debt instrument, which is in the form of a compulsory convertible debentures. Now, the way the law is currently, there are no thin capitalization rules, as we know in India. So there is no mix, there is no specified debt equity ratio which is there under the tax law. You could have any mix of debt and equity, and therefore there is no all that is there is a minimum capitalization that you need to have of a company in India. So what happens in a GAAR situation is that assuming you are in a situation where you're highly leveraged and you have a high component of debt, or a quasi debt in the form of compulsory convertible debentures, and the tax authorities were to believe that this is excessive, then in that situation they could either the interest expense per se, which is excessive in nature, could be disallowed. So there could be an impact on the company that is paying this interest on the disallowance of the expense. Then if this interest is, if this debt itself gets recharacterized in the form of equity, so if it no longer retains its character of a debt, but it becomes more in the nature of a dividend on distributions, then that dividend could be subject to a dividend distribution tax. As we all know, such dividend distribution tax is also not creditable. So there is one impact which is in the form of disallowance of expense in the hands of the Indian company. Second is that the Indian company may be subject to this dividend distribution tax. And the third potential impact could be in terms of the lack of correlative adjustment. What I mean by correlative adjustment is that the income that is actually accruing to the foreign company in a typical debt scenario would be the interest income, which is taxable in India, which will be subject to withholding taxes. Now that interest income, the tax authorities could potentially come back and say that it retains its character as interest, and while on the Indian side the payment could be recharacterized as dividend, nothing impacts the characterization of the income per se. So in a sense, it becomes a double whammy of sorts on both sides, where you are paying dividend distribution tax, you're not getting deduction for the expenses in India, and you're also being subject to tax in the hands of the foreign entity. So this could be some of the issues that need to be addressed, and hopefully once there is some guidance on the thin cap rules, there will be some clarity around this. Now, thin cap rules could take different forms, and in different countries there are different experiences of how these rules have evolved. You could have a situation where you could have either some sort of a subjective criteria or an objective criteria. The subjective criteria would really be to test whether the instrument itself is really in the nature of a debt or not, and there you would essentially look at the comparability, as to whether the Indian entity can actually raise funds in a domestic market from a third party on comparable terms and conditions, and if it is able to do so, then clearly there is no question, and that should retain its character as a debt. But if it doesn't, then it probably does not meet the test. The objective criteria is more driven by determining what are other thresholds that are prescribed. There could be a threshold on up to what extent an interest expense would be allowable, beyond which it could be disallowed, or there could be a specified debt equity ratio that you would see in the form of, say for instance, in the ECB guidelines there is a debt equity ratio of 4:1. So that could be provided as one of the guidance. There could also be situations where debt equity could be, or the ratio worldwide debt, group debt to assets could be used as a basis. So there are different ways in which that objective criteria could be defined, but clearly at this point there is no guidance. One will also need to see at what point in time these thin cap rules are put in place. Fortunately, since the law is not effective from this year, companies will have time to attune themselves and prepare themselves, to conform with such capitalization rules as and when they are introduced. And hopefully there will be sufficient time provided for such change to happen. Let's look at how this impacts in an outbound structure. So we've been talking about inbound structure. Let's look at a typical outbound structure. So let's say an Indian company which is invested overseas and has made this investment through an intermediary holding company located in an SPV in Netherlands, and that in turn invests in the operating company in the US. And we're seeing a lot of outbound investment happening. So there is a lot of investment again happening through an offshore holding company in countries like Netherlands. Now, what if there are multiple investments being made through this holding company? You could have a situation where there is a distribution happening from the operating company into the holding company, okay? And that profit which is distributed in the form of dividend to the holding company does not come back into India. It is retained in Netherlands. As we know that there is a concessional tax treatment available on distribution of profits into India, which is there for, has been extended now, but was there last year for 15% and has now been extended further. But otherwise, in the past, dividends were taxed in India at the full rate of 30%. So if we're also aware that the controlled foreign corporation regulations have been on the anvil or are in the anvil, and likely going to find its place in the direct tax code once it is in place. But pending that, the question that now emerges under the GAAR, in the GAAR scenario, is that could such international holding structures, outbound holding structures, be under scrutiny? For the fact that the dividend or the profits have not been distributed back into the country. Can this corporate structure itself be disregarded because the GAAR provisions have a look-through provision? So can they completely disregard the holding company? Or can this holding company, which is located outside India, be actually treated as a tax resident of India by applying, by shifting the place of residence from Netherlands to India? So those are some of the open questions. One would like to believe that so long as you establish, meet the substance test, commercial, substantial commercial purpose test, as is provided in the definition of the deeming fiction of commercial substance, you will be able to, you will not be subject to scrutiny. But one will have to see what sort of further guidance is provided on this. One could look at building arguments around structures where you have, say, an international borrowing at low rates. One would need to see whether that is good enough to fulfill the requirements of substance. Moving on to a typical inbound structure, and as against what we talked about, where the investment could happen, say, through Mauritius, we often see that companies are looking at Singapore as an investment jurisdiction as well. In fact, a lot of US companies look at Singapore as a very attractive jurisdiction. They have operational substance typically in a lot of these Singapore companies. These Singapore companies could also operate as a regional holding company or international holding company, and by virtue of that status, they are entitled to certain benefits which are conferred by the Economic Development Board in Singapore. And they carry out a various variety of functions which are listed on the slide. Could range from management, administrative, business development, technical support services, etc., etc. Now, when this, as we know, Singapore tax treaty with India also is got a good tax treaty. Provides for tax benefits on capital gains and dividends, and therefore which is similar to what is there in the Mauritius treaty as well. What is incremental and different in the Singapore treaty vis-a-vis the Mauritius treaty is a limitation of benefit clause which is there embedded in the treaty, and which finds its place through the protocol, and which says that which is basically in some sense an anti-abuse provision, which seeks to provide protection and therefore especially with respect to conduit structures, to say that if this capital gains exemption will not be denied in a situation where that entity which is located in Singapore fulfills one of the two tests: A, the stock exchange test, which means that it is listed on a recognized stock exchange, and B, that the annual operating expenditure in that Singapore company is not less than 200,000 Singapore dollars or 50 lakh rupees for a period of 24 months before the date of sale. So if either of those two conditions are in some sense met, that will fulfill the substance, the LOB provisions under the Singapore Treaty. Now, the question that emerges is that fulfillment of these tests, one of these tests under the treaty, is that good enough for GAAR not to be applied in these situations? And I think it's interesting to note that there was a representation that was made by the Indian Banking Association to the ministry, and when the direct tax code bill was presented before the standing committee, at that time a representation was made, and the remarks of the ministry to the banking association was that limitation of benefit clause under treaties has limited applicability, or limited it is applicable in certain situations, and therefore the canvas of GAAR that is contemplated is much more wider in scope, and therefore all situations and all circumstances that are meant to be covered under GAAR may not be covered through this limitation of benefit article. So it somehow seemed to suggest that it may not be sort of the limitation of benefit would not give a complete protection to these kind of structures, and one would definitely need to look at what other substance one would need to establish. And maybe in a situation where you have a regional holding company, an operating holding company, or international holding company, you are fulfilling those substance tests, but one would need to keep a close watch as to what level of operational substance you have in Singapore. Moving to the next slide, and I think this is just more of a procedural overview in terms of how the process will work when a transaction is selected for scrutiny. The starting point the matter will be picked up by the officer, and the officer will then refer the matter to the commissioner. The commissioner will hear the taxpayer and determine whether this is a case for GAAR or not. If he believes that it is a case for GAAR, then he will refer the matter to a 3-member approving panel. The approving panel, as we know, originally constituted of 3 commissioners, from within the department. And but however, when the representations were received before the Finance Act was passed, then finally that was in some sense made partially independent, with the introduction of one member not from the department, which would be a member from the legal services, not below the rank of a joint secretary. So that's really the composition as it stands today. If the finding of the approving panel is that this is a case for GAAR, then they will actually pass an actual direction. They give a direction back to the assessing officer, and the assessing officer will then pass an order saying that this is an impermissible avoidance arrangement. Now, if you look at it, there is no recourse for appeal that is available to the assessing officer if the matter is finalized in favor of the taxpayer, to say that this is not a case for GAAR, or this is not an impermissible avoidance arrangement. So that's the end of the road. The assessing officer cannot appeal further. However, if the decision is that this is an impermissible avoidance arrangement, and that's the final conclusion, then the taxpayer has a right to appeal to the next level, which is a tax tribunal. So it is a one-way appeal. Now, this may be the current form, but as we know that similar provisions were also there in case of the dispute resolution panel, where we had only one-way appeal that was possible, and based on experience of the DRP, where there weren't really many positive decisions coming. Now in the current year's budget, or in the Finance Act, they have now extended this right of appeal even to the revenue. So one would have to watch out as to whether a similar right of appeal would be given even in such cases to the assessing officer. Let's look at, there was a lot of representation that was received clearly from all sections, whether it is from the investors, whether it is from businesses, in domestic Indian businesses, foreign businesses, in terms of trying to look at, as we know, the Finance Minister has consciously originally not included the recommendation that were made by the Standing Committee on the GAAR provisions. But after a lot of representation, the Finance Minister did consider some of these recommendations before the Finance Act was passed, and some of these recommendations, other than the fact that the GAAR provision itself have been deferred by 1 year, which is essentially to allow both the taxpayers and the tax authorities enough time to deal with the various issues that come up. So it's been going to be applicable from 1st of April 2013. The second important update is that the onus, which was partially on the taxpayer and partially on the tax authorities, at least on the taxpayer as well as the first test is concerned, the main purpose test, has now been completely shifted to the tax authorities. So there is no onus on the taxpayer. for an arrangement to be treated as an impermissible avoidance arrangement. And the third part is with respect to the approving panel. As we discussed, that the approving panel now has a member from the legal services, which is to bring in some level of objectivity and transparency. The question that still remains is that whether this is good enough independence, because there is really nobody from outside of the, in that sense, there is no independent industry person or representation in that panel, and that would have really brought in a lot of independence and objectivity into the process. The authority for advanced ruling is an option that was again is something that the industry was hoping for, that there would be, and is something that does find its place now. So it does come as a welcome relief, where taxpayers have an ability to reach out to an independent authority to determine in advance where a transaction could classify as an impermissible avoidance arrangement. So these are some of the changes that were brought in before the GAAR provisions actually got legislated. And but that still does not water down the provisions completely, and there are several other recommendations that were made by the standing committee which have still not seen its place in the Finance Act, and one would have to wait and watch whether the final the draft guidance or rules which are framed will take into consideration some of these recommendations. One is there's clearly no de minimis threshold which is being prescribed under GAAR. We are aware that the CFC regulations, which originally also did not have a de minimis threshold, now have a threshold of 25 lakhs, 25 crores, and therefore in that sense there is some level of threshold which has been provided there. The grandfathering provisions again are absent at this point, so as to safeguard existing structures. And this is something that we talked about in one of the, in some of the original slides where we talked about investment into India. So it will be important to see if there is some level of relief or given to the taxpayers to protect existing structures which have already been entered into to be not be covered under GAAR. And third is there is no positive or negative list. So if one doesn't know if that there are certain kinds of transactions, for instance, if one was to do a genuine restructuring which has been through a court approved merger, would such transactions be under attack? And there is clearly an approval which has been given by the court, or endorsement which is given by the court. So there is no set of exclusions or carve outs at this point of time on what transaction will not be under a cover of GAAR. There are no key tests which are prescribed. As I said, there are no definitions to commercial substance. There is no definition to what constitutes misuse or abuse of the tax code. There is no definition to bona fide business purposes. So there are several of these definitions which are lacking today in the way the law has been framed. And as I mentioned, there are several other recommendations that have come in from the standing committee, which will hopefully, one would hope that they will find its place once the rules and guidelines come in. So really, I think there's a lot of work which is still work in progress. There was a committee which was constituted under the chairmanship of the Director General of International Tax, which was really to deliberate on some of these issues and to make recommendations on what sort of rules and guidelines should be framed and what sort of safeguards should be built into the GAAR provisions so that these provisions are not used indiscriminately. So that's something that one is waiting for. These were supposed to go in and by May 31st, and one would hope that a report will be out soon on that, and it'll be interesting to watch as to what some of those recommendations are. But there's clearly I think that the one disconnect that seems to be there, if you look at the memorandum, clearly the memorandum does not simply restrict itself to simply tax evasion or say abusive tax avoidance. It also talks about aggressive tax planning, and as we know, there is a thin line between what constitutes abusive tax avoidance and aggressive tax planning. So it'll be interesting, while GAAR rules have really been framed, it will be interesting to see as to how does one make that distinction, and having clarity on some of these undefined terms will hopefully help in addressing some of these concerns that businesses and investors may have. So what does this mean for all of us? I think as I said, there is no clear directional steps as such, because the GAAR rules are still evolving and further work needs to be done on this. But at least it is time for one to step back and take stock of potential transactions which may be under scrutiny under GAAR, and as at this point of time it could impact current structures, it could impact future transactions. So as one would need to look at both sides and also look at trying to see what is the level of substance that really exists, and maybe this may require just a documentation of what is there. But clearly documentation is going to hold a very important key, to establish your bona fides as and when this transaction does come under, any of the transactions come under scrutiny. So the commercial substance test, once there is some clarity around what sort of commercial substance is required, it will be important for one to take stock of that. Advanced ruling, we've talked about, some level of homework needs to be done and an appropriate strategy to be built before one looks at going in for an advanced ruling. And clearly there is a need to watch out for what sort of guidelines and report is issued by this committee that has been constituted by the government. So these are some of the things that one needs to watch out for. But clearly, what India has done in terms of introducing GAAR is not something which is unique in that sense. Countries all over the world are having to deal with anti-avoidance rules and anti-avoidance situations, and many of the countries do have codified legislations, are in the process of codifying GAAR. As in the case of UK, as we know that UK has been toying with this idea for a while, and finally, after the recommendations of Aronson in his report, this has now finally been in some sense blessed by the legislature, and a consultation paper has been issued which very recently which spells out the broad framework of the legislation that is going to be introduced. So it's not unique, and several other countries are looking at it, and therefore in that sense what India is doing is not very different. But yes, the concerns of the businesses and investors are completely valid, and one would like to see further sort of guidance to make sure that the apprehensions of all stakeholders are addressed once the rules are finally in place. Let's move now to the second part of this presentation. And the second part of this presentation is to do with the expanded definition of royalty. And I think this is again a significant development. As I mentioned in the beginning of my presentation, that this is applicable, has been introduced with retrospective effect from 1976. Interestingly, that this provision was not there either. These proposals were not there in the direct tax code, whether in the original form or when where the direct tax code bill was introduced. So really, this is something that has taken the industry a little bit by surprise. And when I look at this expanded definition, I'm going to talk about two or three kinds of payments. One clearly is software, which has been sort of under litigation over several years. And second aspect, which is really impacts the media industry and the telecom industry, is to do with the transmission charges for hire of transponders, and connectivity charges, which is more for bandwidth and telecom kind of payments. So we look at what the impact is and what are the key considerations that taxpayers will need to look at as a deal with some of these provisions. So maybe let me start by saying what could be the different transaction models. And when we're talking about a software industry, you could look at different kinds of models. As has been depicted on this slide, you could have a centralized model of software distribution where the software is directly sold from outside India by a foreign company to a customer in India. So, or it could be a decentralized model where you actually sell the software through distributors. Distributors could in turn sell to resellers and then to customers. You could also have a different strategy in terms of how do you deal with the licensing. So you could have a situation where there's a perpetual license being given, so you have the right to use the software for an unlimited period of time. Or you could have license which is given on a pay-as-you-use kind of basis, which is something that we're seeing with the emergence of cloud computing and software as a service. So this could be on a usage model and could be in the form of a subscription revenue. The software could be sold either in a physical form, it could be sold electronically, it could be sold on a standalone basis as a shrink wrap software, or the software could be customized with modifications. Software could also be bundled with services. So there are different kinds of models which are there in the industry today, and the amendments that have been introduced seem to impact almost virtually all of these models. Before I get into what the amendments are, let me step back and talk about what the controversy is all about. So the controversy, as we know, is there are two sides of arguments. The arguments that the revenue takes is that the supply of software simply involves use or right to use of any copyright, and they have taken a very restricted meaning to what is use or right to use copyright. So even making of a single backup copy for archival purposes is something that the tax authorities argue is use of copyright. And if it is held to be taxable as royalty, then the income is taxed on a gross income basis, which is basically to say it's taxable at 10% or 20%, and without allowing any deduction for expenses. On the other side of the spectrum, you have the tax authorities, the taxpayer, which says that no, when I'm supplying the software, it does not tantamount to use or right to use of any copyright. One has to look at what is copyright and what are the copyright rights which are being transferred. There has to be a clear distinction which has to be made between a copyright right and a copyrighted article. If it is a transfer of a copyright right, which is where I get a right to exploit the copyright, then in that sense the payment will assume the character or take the character of royalty, whereas if it is only a sale of a copyrighted product, then in that sense it will be taxable as business income. So and if in that situation, if the foreign company does not have a taxable presence in India, then this income should not be subject to tax in India. So these are two sides of the spectrum, arguments which are being taken by the revenue and the taxpayer, and the matter has been on litigation for several years. And this slide is just to demonstrate that the litigations, having started from 2004, 2005, initially you had a landmark decision of TCS, which is more in the case of sales tax, but then gradually we had decisions on software under the income tax law, which traveled from the tribunal to the High Court. And we've had some positive decisions in case of bundled software, as you can see, in the case of Motorola, and more recently in the case of Ericsson. There have also been certain favorable advance ruling on this subject, for instance in the case of Dassault, and there is a Mumbai Tribunal decision of 2011 in the case of Novel. But then at the same time there are also some very adverse rulings, and there are jurisdictional High Court decisions which have happened in case of Samsung and Wipro, both in 2011, which confirm that this is a case of right to use software, right to use transfer of all or any rights in respect of copyright is software is intended to be covered there. So there, even more recently in 2012, we've had some rulings which again have been adverse. So the matter has been under dispute, understandably, and there has been no clarity on this issue. But as the matter has now travelled in some sense to the Supreme Court, and one was hoping that a final sort of clarity would emerge from the Apex Code. At this point, the government has come back with this amendment, which seems to amend this law retrospectively, going back to 1976. So let's look at what this amendment is, and it's a fairly radical amendment which has been introduced. Just to read out the explanation, as you can see on the slide, the explanation 4 has been added to section 916 of the Income Tax Act, which starts by saying that for removal of doubts, it is hereby clarified that the transfer of all or any rights in respect of any right, and emphasis on any right here, property or information includes and has always included transfer of all or any right for use or right to use a computer software, including granting of a license, irrespective of the medium through which such right is transferred. And if you look at it, really, all the controversy that was there in terms of looking at whether it is transfer physically or electronically, what are the set of transfer, what are the kind of rights which are being transferred, in some sense has been put to rest. One could still argue that the treaty definition is narrower, but which we'll come to that a little later. But if you look at it from a domestic law perspective, there doesn't seem to be an argument to say that this transaction is not taxable anymore. There's a school of thought that the place where this explanation has been introduced seems to suggest that one interpretation could be that this transaction does not broaden the definition of royalty. But that's a hyper-technical argument which probably will have to be tested again before the courts. But in the position under the law, or the domestic law, seems fairly settled in some sense to say that this transaction will be taxable. The distinction between copyright and copyrighted article is no longer relevant. And even on the domestic leg of the transaction, there will now be an impact, because section 194J covers royalty, and for the purpose of royalty, one needs to go back to the amendment that has been introduced under section 916. What was interesting is that the finance minister, there were representations that were made to the finance minister that introduction of this amendment is going to cause undue hardship to domestic taxpayers, especially in the case of domestic sale of software through multiple in the software chain. So what has been a sort of a relief in some sense has been a notification that has been introduced only yesterday on June 13th, where the finance minister has clarified through this notification that the finance ministry has clarified through this notification that in case there is a TDS applicability at multiple levels, then one would only look at applying TDS to be applied at one level of the first level of the transaction. So if the first level of the transaction happens to be on the import of software, then so long as you have deducted tax on that import transaction, there should be no further impact on future sale of the software at the domestic level. If, however, there is no tax at the international level and the first transaction or the first point at which you're deducting tax is at the domestic level, then on every subsequent leg of the transaction, no withholding should apply. So essentially, it's maintaining parity between a transaction where a software is imported from outside India versus where a software is probably sold domestically. And that should come as a bit of a relief to taxpayers to avoid this multiple levy and having to deal with the issues of claiming credits. Let's come to the second, and I know I need to talk about the impact under the tax treaty for software payments, but I will combine that with the impact on connectivity and transmission charges. Again, on connectivity and transmission charges, there are two sets of views. One set of view is really to say, which is the revenues arguments, and the arguments which have been taken are largely similar on both sets of payments. To say that the payment is for use or right to use of any process or industrial, commercial or scientific equipment. These are the arguments that are taken by the revenue. And there again there is a further dissection in terms of looking at whether the process needs to be secret or not, and there are judicial precedents which go into whether the process needs to be secret or not. But if based on this view of the revenue, if it is taxable, then clearly there will be withholding tax applicable on a gross basis at 10% or 20% as the case may be. And however, the taxpayers' arguments are that no, there is no use or right to use of any process or any industrial, commercial or scientific equipment, because really the person who's getting this service is really paying for a service, and he is availing of a standard facility, and such use of service or standard facility should not be subject to tax as royalty. The taxpayer neither has possession or control over the equipment, especially in case of the transponder services, where he is paying for transmission or transmission charges for availing the transponder which is housed on a satellite. In that situation, he does not have any physical possession or control of that equipment. The equipment belongs to the owner of satellite and not to the broadcaster who is making the payment. So, the taxpayer arguments are that this is not a process, this is not use of industrial, commercial or scientific equipment, and they should not be taxable in India in the absence of a P. So the matter again here has been under extensive litigation, and the next slide actually talks about the cases for and against, and there are two ends of spectrum. On one, clearly on the transponder hiring charges, there are cases which initially started off as two contrary decisions, one of AsiaSat, which was a negative decision, and then there was a positive decision in case of PanAmSat, where there was a US treaty involved, and then matter went up to the special bench, and in the special bench, in the case of New Skies and Shin Satellite, the matter was upheld in favor of the revenue to say that this transaction is taxable as royalty because it is use or right to use of a process. And then, finally, what came as a welcome relief is when the Delhi High Court, in the case of AsiaSat, as late as 2011, confirmed that there is no use or right to use which is conferred here, and in that sense, this transaction should not be taxable as royalty. And one was hoping that this would put in some sense an end to this dispute. Even if the matter goes to the next level, this will be finally upheld in favor of the taxpayer. And so this was as far as the transmission payments are concerned. At the same time, there were decisions that were there supporting with respect to bandwidth and connectivity charges. There were case laws in the case of Cable and Wireless and Dell and ISRO, which supported that such transactions should not be taxable as royalty, because what you were getting was really a standard facility. But then these were controverted in a more recent decision of the Chennai Tribunal in the case of Verizon Communications, where such dedicated bandwidth or IPLC charges, the payments that were made in respect of that, were held to be taxable as royalty. So both on the voice data as well as on the satellite payments, there seems to be, decisions have been oscillating on both sides of the spectrum, and finally culminating into some positive decisions, some negative decisions. But one was hoping that the law of the land would finally give relief to the taxpayers till this amendment came in, and these amendments again have sort of taken all those decisions into account and introduced amendments to negate the impact of some of those positive decisions. So if you look at what the changes are, there are two sets of explanations that have been added. One which says that royalty, which one which does not give much significance to tests related to possession, control, and usage of rights. Again, some of these were important tests established in certain cases, but these have been rendered irrelevant in determining whether transaction is taxable as royalty or not. And second is that the process definition has been defined to say that it is always included and deemed to have always included transmission by satellite, cable, optical fiber, or any other similar technology, irrespective of whether such process is secret or not. So again, coming back to to summarize, this is also in some sense giving a settled, so to say, a settled view on the domestic position as far as taxability of such payments is concerned. But if we move to the next part, which is really under the treaty, there are two arguments for and against. And if you look at the argument, for just look at the arguments for, then clearly one would believe that there is a narrow definition of treaty narrow definition of royalty under the treaty, and that does not get impacted by this amendment that has been introduced, and that should continue to hold good. Also, there is a view, and rightly so, that the treaties have to be interpreted in good faith and in a spirit in which with respect to international laws and agreements. And therefore, which is also the whole concept of respecting treaties also finds its place in the Indian Constitution. And then, if you look at the last bullet, I will take in along with the case against the treaty. Some of the arguments against the treaty seem to be that there is now going to be an increased threat on such transaction because the law has been amended. The definition has been introduced, which has expanded the meaning of the term royalty. But at the same time, they have also introduced another provision, which is an amendment to Section 90, which says that if a term is not defined, under the treaty, then there could be a notification introduced at a later point of time. And by virtue of that notification, which is issued by the CBDT, that term can be defined. And once a term is defined, then it will have the same meaning. It will carry the same meaning from the time the treaty came into force. This seems to be a very damaging amendment. The argument, in favor of saying that this should not apply is to say that, one cannot amend the law unilaterally and therefore override the tax treaty through that means, and therefore this should not be used to make an amendment at this future point of time through this notification. And the tax residency certificate is another requirement which has been added, and that's going to make it difficult to apply the treaty because you will necessarily have to go back and get a residency certificate, which may be a challenge in some of the countries. And at the same time, the memorandum to the Finance Act also says that this is not the only test, but one of the tests for determining for claiming treaty benefits. There are certain treaties clearly which do not, where there are certain treaties where the software has been specifically included within the definition of royalty, and that really may be a little, damaging because in such situations you will be taxable as royalty. And on the process side, for instance, treaty with, there is a treaty which pretty much suggests that that this transaction of transmission by satellite, optical fiber, cable, etc., will be taxable as royalty, and in that sense, that treaty position should, in that sense, there is no safeguard available under the treaty. But I think, having looked at all of this, I think one thing that sort of comes out, which may come to the rescue of the taxpayer, is a statement that was made by the finance minister in his speech before the parliament, which says that these clarificatory amendments should not override the provision of the treaty. So wherever there is a relief that is available under the treaty, that relief should still continue to be available. To come to more or less to the conclusion, there have been some recent developments that have happened, and I think that should give some bit of relief to the taxpayers. One is a recent decision of B4U International Holdings, which came out on 28th of March, which essentially says that even though the transaction may be taxable by virtue of these retrospective amendments, there is no, and this was in context of transmission charges, transmission payments that were made to satellite companies. And in such situation, the restricted scope of the royalty definition is under the treaty still holds good, because the treaty has not been amended between India and US, and therefore the retrospective amendment should have no impact on the position under the treaty. So that's a welcome decision. And the second important aspect is with respect to an instruction that has been issued by the CBDT on 29th of March, because there was a lot of concern with the possibility of these amendments being introduced, where cases could be opened for several years, several back years. And there, I think the tax authorities, the CBDT has come back and sort of clarified that if the assessment has already been completed, if the proceedings have already been completed under 143(3) of the Act, then such reassessments, such proceedings will not be reopened under any reassessment, or if no reassessment notice has been issued before 1st of April 2012, then in such situation, such proceedings, such cases will not get impacted. But again, there are a lot of issues around this, because there are issues on the withholding side, there are issues on interest, etc., which still need to be addressed, and issues around years which have already been opened or reopened. What happens to cases on those which have still not culminated. So a lot of issues that still need to be deliberated and looked at, even though there has been some clarity which has been provided for the past years. Again, to conclude on this part of the presentation, what are the key considerations that taxpayers need to look at? Clearly, one needs to determine whether there is an eligibility for treaty benefit or not on the international leg, and one would like to believe that even if the domestic position has been expanded, the treaty position should not be altered, and one would need to look at the treaty position and decide whether one wants to continue taking that position. The tax residency certificate format, which has been mentioned, that one needs to obtain a tax residency certificate. There has been no certificate which has yet been prescribed, and pending that, it may be appropriate for taxpayers to look at getting some sort of a declaration based on which they could apply the treaty benefit. The definition of the expanded definition could have its impact even on payments between two non-residents, especially so with respect to payments happening, say, from a broadcaster to a satellite company, that those payments could happen outside India, and because of the definition being amended, this could have its impact on withholding on such transaction as well. The interest continues to be an area of concern, because there is no protection on interest, both on the side of the payer and the payee. So you could have a situation where there is a double whammy of interest, both on the deductor side and the payee side. Finally, there may be some relief in terms of, which is not specific to this provision, but in general, which has been introduced prospectively, to say that if you have deducted, if you haven't deducted taxes to a payment made to a resident, another resident, and if that resident has paid his taxes on that transaction, then you should not be disallowed deduction for the expenses for having failed to deduct tax. So this will come as some sort of a relief, but one will need to do certain compliance, like getting a certificate from a CA and getting confirmation or a declaration from the payee to the taxes have been paid. And finally, there will still be certain kinds of transactions which may not have an answer at this point, and companies may need to look at especially in a software scenario where you have software bundled with hardware, how would you deal with those kind of situations? Does one now need to look at splitting contracts to be able to have more clarity at least on the hardware element? So all in all, this is we are headed for some interesting times, given that these amendments have been introduced, which have far-reaching implications both for past and future transactions, and therefore taxpayers should sort of look at doing some sort of a detailed analysis to understand and assess what could be the impact of this on their business. With that, I sort of come to an end to my presentation, and I'll be happy to take on questions. Question. Should we start? I think there's a question which is coming. So I'll just take up a couple of questions while the questions are still coming up on the screen. There are some interesting questions that have been raised, which before us, that I may want to. One is really, can GAAR be invoked on representative assessees? And we know that there is a concept of representative assessee, which is there under the law. Your taxpayer could be, and representative assessee is normally used for non-residents, and sometimes the collection or the recovery mechanism is initiated on representative assessees. So while there is concept of representative assessee, one would believe that will be more used. The GAAR principally should apply on the foreign company or on the principal assessee, but the collection of taxes can still happen from the representative assessee. Do you think GAAR will be implemented in the next financial year? Well, I think I think the way the finance minister has put it down in the budget when he discussed this before the parliament, was that the purpose while the GAAR is being delayed by 1 year is to essentially allow both taxpayers and tax authorities to resolve, to address all issues. The fact that a committee has been constituted, the committee is submitting its report, I would tend to believe that, and the fact that it's there in a form in the act itself, although deferred for a year, one would tend to believe that GAAR may find its place. If it doesn't find its place in the next financial year, I mean, clearly there is a direct tax code which is also annual. Unless both of these sort of, the direct tax code bill also gets deferred for some more time, one would tend to believe that GAAR should come into force from 1st of April 2013. The other question is around one of the main purposes. I think this is an interesting question, is that can you really have multiple main purposes? I think a valid question that typically one would believe that we talk about main purposes, it has to be it has to be one of the main purposes is in that sense could be equated to something like when you talk about under company law is you have multiple main objects, even though it is supposed to be a main object. So it seems like one of the main objects, one of the main purposes seems to be cover a situation where there are multiple purposes involved in a transaction. So that seems to be intended here as part of this. Yeah, I think section 1, I think that's a valid point raised by Praneeth, that section 194J refers to 916 for definition of royalty. 916 explains, explanation 2 defines royalty, however, amendment is made only to include explanation 4. Can one take an aggressive view that the amendment will not apply to domestic transaction at all? I don't think so. One would want to take a view on the withholding side. I mean, I think there are interpretations possible that the placement of this amendment is under explanation 4 and not under explanation 2, which defines royalty, and therefore one should strictly look at applying explanation 2 itself, and therefore one should read them independently. But to my mind, that is going to be matter which is going to be which is going to be litigated, highly litigated. And as a deductor, I would tend to believe that given the consequences that are there for failure to deduct in terms of disallowance of expense, interest, penalty, etc., one would want to be a little more cautious. Clearly, if it's a foreign company, you may still go ahead and take a view that applying the provisions both under domestic law as well as the treaty that this transaction should not be taxable. But I would not recommend, given the way the memorandum has framed this amendment, that one should take a view that this transaction should not be taxable, should not be subject to withholding taxes. Yes, I think Shivdev, your question that implementation of GAAR has led to difficulties in different jurisdictions is a fair point, and maybe that's the reason why most of the countries follow a consultative approach before introducing any legislation. UK has taken its own time to come up with a with its own draft version. And again, in the draft version, it is not seem to be as stringent as it is under the Indian GAAR, because it doesn't even have a situation where you have a an approval panel. In fact, what it has is an advisory panel. It also does not even define what are the consequences if GAAR is invoked. In fact, what all it says under the UK is that that if GAAR is enforced, it should be done in a fair and a reasonable manner. So in that sense, I would agree that the GAAR is not meant to be applied in a broad brush manner and in an expansive manner as probably what is contemplated at this point under the current GAAR framework. But I would believe that the reason why the GAAR has been deferred by 1 year is really to iron out these issues, to come out with clear guidance as to when what sort of transactions. Maybe you won't get a list of transactions, but hopefully the safeguards would be fairly robust enough to show that it is used really used sparingly and not in every situation. Yeah, I mean, that's a question that's there in everybody's mind, and I think the finance minister is very keen to bring it in the monsoon session. There's the DTC implementation. The question from Vivek is, will DTC implementation be there by April 2013? Again, it depends on how the government, what the outlook is on that. But everything seems to be in place. I think, in some sense, the provisions that were, one will have to see what sort of recommendations are considered from the standing committee report. Finally, in the DTC that is tabled before the monsoon session, but there seems to be a strong indication, at least from the finance minister, that he will introduce it by April 2013. I think another question is, how does this GAAR interplay with other anti-abuse provisions which are there in the tax code we have? I think that's an important aspect to be looked at. We have specific anti-avoidance rules in the form of with respect to carry forward of losses in case of merger under 72A, or with respect to situations where you have splitting up or reconstruction of business under section 10AA. So these are specific anti-avoidance rules which are there, and one would like to believe, or it seems fair that where you have a specific rule, that should not be overridden in that sense by GAAR, and those anti-avoidance, those anti-abuse provisions should prevail. But again, one would hope that once these guidelines are issued, there would be more specific clarity around that. Yeah, so that is a fair point. I mean, there is a clear disconnect, and I think that disconnect still holds good in terms of multiplicity of taxes, where a transaction there is inconsistent treatment from an indirect tax or direct tax. I think, sorry, to go back on the question. The question from Raghavendra is that the sale of imported software is subject to TDS as well as service tax if the sale is in the domestic market, and I think that's a fair point. So you have a situation where you're treating it as a royalty on one hand, at the same time you're treating it as a service subject to service tax, and both of these are in that sense federal levies, because service tax is also administered at the central level, and so is income tax. But there seems to be a clear disconnect in terms of classification. So again, because there are independent levies, you can go back and make representation, but I think the views of the government seems very clear, that the position under one law should not impact the position under the other law, but clearly there is a disconnect. So I think the question from Pinky of BMR is, what kind of documentation will be required to prevent against GAAR other than TP documentation? And I think it's not just about transfer pricing documentation, because transfer pricing is only one element of the tests that you need to fulfill, and that is only if you're talking about the specified condition test around related party transaction. I think the documentation requirements will come out from what is the definition of commercial substance and specified commercial purpose. So one really needs to look at the whole transaction as such. If you have, say, a joint venture, one will need to look at how it's been documented in the MOU. You may need to look at how you're documenting your notes to accounts, how you're documenting your notes to the return. So I think documentation has to be looked at in a holistic sense and not just limited to one set, but the intention of entering into a particular arrangement or a transaction needs to be now more explicit. And I think that will really, this will really emerge once more detailed rules and guidelines are issued and once the definitions are in place to see what kind of substance, what kind of documentation one needs to maintain.